Hello and welcome to our AIM Summit webinar on the global investment landscape, heading for a reset. This session is sponsored by Corinth Capital Investment Fund. I'm your host, Zachary Seferati, the CEO and founder at Down Capital and strategic partner of AIM Summit. We have members in this audience coming in from over 40 different countries. We've looked at the audience, and amongst you are institutional investors, family offices, high net worth individuals, and leaders of the financial services industry. Thank you so much for joining us. We will have a Q&A session after two presentations, but please feel free to submit your questions as they come through on the Zoom Q&A webinar or dialogue at the bottom of your screen. If you're joining us after this session on YouTube, please like this video and subscribe to our YouTube channel now. Introducing the partner for this webinar, Corinth Group of Companies is a private venture capital investment group with a fully licensed and regulated alternative investment fund, namely Corinth Capital RAFE VCIC Limited, which is registered with the Cyprus Securities and Exchange Commission, or CySEC. The Corinth Investment Fund focuses on selective, direct private investments globally, which, given today's economic conditions, meet the environmental, social, and governance criteria, or ESG, which generates sustainable revenues and high returns. ESG has certainly been a central focus this year in 2020 and throughout the AIM Summit history. It's my pleasure to introduce our first speaker today, Sir Christopher Pissarides. Sir Christopher Pissarides is the 2010 Nobel Prize laureate in economics. He holds a Regius Chair of Economics at the London School of Economics, LSE in London, and he is a macroeconomist specializing in the economics of labor markets, economic growth, and structural change, especially as they relate to obstacles to free market clearing. His research includes employment implications of automation and artificial intelligence and the emergence of China as a global economic power, some of the key issues that keep many of us awake at night. He is the author of several books and articles, and he chairs the Committee on Greek Economic Growth, advising the Prime Minister of Greece as a senior economic advisor of the McKinsey Global Institute. Among other prizes and Academy Fellowships for his work, he was awarded Knighthood from Queen Elizabeth II. Sir Christopher Pissarides, it's such a pleasure to have you with us today. It's such an honor to be introducing you in this session. Very excited about learning about some of the new trends that you've highlighted underlining investment decisions, particularly as they relate to ESG and technological advancement. Sir Christopher.
Thank you very much, Zachary. Thank you for that generous introduction. I intend to talk about recovery from the COVID-19 pandemic, where I see the world going, the investment environment. But before I do that, if you would allow me a couple of seconds to put some slides on the screen that will guide our discussion. This is a little bit of technology here. Okay, here we are. New trends underlying investment decisions, and we can go immediately to slide number 1. Okay, I begin with the road to recovery from COVID. The COVID-19 pandemic has caused unprecedented sudden stops in economic activity, which are still with us. We are not out of the woods, of course, yet. But it's also changed the way that companies, persons, and governments do things and generated many ideas about the future. In my field of economics, it's as if the whole profession stopped what they were doing and are now studying the implications of the pandemic for jobs, financial markets, supply chains, and trade. To give you an idea of how much work is going on in economics, just consider this. One of the main international series of working papers on labor markets published 180 papers on COVID-19 between March and October this year. And that's only labor markets. There is still finance and supply chains and trade that is published elsewhere. Now, recovery from the pandemic will not be uniform across the world. Countries whose governments have succeeded to keep more workers in their jobs through furlough schemes will bounce back faster. because there is always an advantage to having people at jobs, even if they are not performing. As soon as a new opportunity arises, they get into production quickly. Favorable monetary and fiscal policies will also help. This is not the time for interest rate hikes or fiscal austerity to repay debts. Interest rates at zero, keep them there until the economy starts growing again. Open economies that rely more heavily on exports for demand will be faced with more uncertainties. And that puts smaller economies maybe at a disadvantage because usually smaller economies export more. We know from preliminary data coming on stream that automation is accelerating and work arrangements are changing. Countries that have more flexible labor markets will find it easier to adapt to the new conditions. Now, what are the new realities now of the post-COVID economic world? Suppose that we're out of the woods. What do we see? In crisis situations, people learn new things, and this knowledge transforms the way that we do things after the crisis. It's a time to rethink, take stock, and then start something new. The world after COVID will be different from the one that we left behind. Focusing on the way that business is done, because there are implications of COVID for the way governments do, the way households behave, but I want to focus on business. In this pandemic, we learned three things that will have long-term impact on the way that we do business. The first one is that many jobs can be done remotely, at least part of the time. A hybrid model with some office work and some work from home will become the norm. An influential study for the United States, done at the University of Chicago, concluded that about 37% of jobs can be done at home. These jobs are better paid professional jobs, and by extension, poorer countries have lower ratios of remote work. So reality number one, there is going to be more work done at home, mainly in high-income countries. Second, online shopping and service provision will also become the norm. This includes consumer goods like food deliveries, but crucially, it also includes services. Banking is taking the lead in this trend, but others like health and legal advice are also adopting teleconferencing or online consultations. Personally, I've already had consultations with my bankers in London, with my doctors in London, all done remotely, me sitting here in my study at home. Finally, there is more emphasis on the environment and the damage that human activity does to it. The pandemic has brought home the need to do more to control climate change. Even the Beijing air has cleared up in the early days of the lockdown, and we're already seeing changes in perceptions and policies that have been induced by this change that we observed about a month after the pandemic. Moving quickly, because I do want to hear your questions and the fireside chat as well, let's look at the implications for markets. Now, as automation is now moving faster, countries which give priority to innovation, for example, the ones that score high on the Global Innovation Index, will have a comparative advantage coming out of the pandemic. These countries include the large economies of the United States, China, Japan, and Germany, and several smaller ones, of course. Countries that are taking proactive measures to manage the unforeseen health crisis will also have a speedier economic recovery. These countries are also the ones that have more occupations that can be done remotely and more highly developed health systems. So overall, I expect COVID-19 to widen the gap between rich and poor nations. This is not a good outcome if we leave it alone, but for better or worse, we see countries with the better innovation, the better R&D, the possibilities for more remote work, the better health systems. They are concentrated in the high incomes countries, mainly of Western Europe and North America. There are some others, of course, like Japan. Remote work, combined with more use of the internet and computer software, creates new challenges for markets. First, cybersecurity becomes a big issue. Can we handle it? Companies that manage to find better ways of surveillance and bringing cyber criminals to justice will do well. Cyber attacks can target both companies, but can also be used for political objectives. interfering with other countries' politics. It's very difficult to identify such attacks and even more difficult to bring them to justice. I prefer not to mention direct examples because they're controversial, but we can all think of some that we heard in our daily news. Second, and easier to handle, is the organization of cities and travel. Currently, there is a large infrastructure addressed to the needs of dense business locations in city centers. Public transport, taxis, restaurants, office buildings, all kinds of activities that office people want to do near their place of work and they're prepared to pay for. Our cities are full of them. If remote work goes up to an even conservative estimate, such as 20%, that means 1/5 of all these services will lose their customers. Many will not be able to survive, and real estate will be badly hit, especially commercial real estate in city centers. At the same time, demand for services of this kind will go up in residential areas. In fact, the fact that homes will be populated for a much longer stretch of the day than currently increases the demand for home delivery services, such as food, cleaning and maintenance, online shopping, and even things like car washing and personal training. So I expect to see business addressed to the household to go up. It makes so much difference when you're at home and you're expecting a delivery than when both of you or everyone in the household is working or is in school and you start trying to negotiate how things will be delivered, who will open the door. So that aspect of the market, I expect to get a positive hit. Now, investor focus. Now, of course, investors are following these trends. They're always ahead of the curve. What are they becoming aware of? And do we see any trends developing? The main one that I see is the economic benefit of environmental related sustainable investment opportunities, such as green energy and waste management. We still use too little renewable energy. We recycle too little. And although the circular economy is gaining momentum, it's still way, way behind its potential. The trend towards sustainable investment is becoming stronger as we're coming out of the pandemic. Governments are focusing, and if they are not, they should be focusing, on sustainability as the core of their recovery plan. They encourage, through subsidies or tax incentives, investments in large-scale projects with renewables, in clean transport, in waste management and recycling, in sustainable food, in healthcare, and in many other related destinations. Until a few years ago, the strong view held by investors was what's known as the Friedman Doctrine, named after the famous Milton Friedman, economist at the University of Chicago. Essentially, the Friedman Doctrine said that the best way that a company can serve the interests of its shareholders and society at large was to maximize profit. To put that succinctly, at the New York Times article in around 1990, I think. In the past few years, there has been widespread criticism of this doctrine, with commentators and big investors focusing on alternative objectives related to sustainability, diversity, and putting more emphasis on stakeholder interests, including employees, customers, and the local community. You may have seen the influential letter that Larry Fink, chairman and CEO of BlackRock, a big asset management company, the letter that he sent to CEOs in January 2018. These are CEOs of companies where BlackRock is invested. He talked about accountable and transparent capitalism, in which climate risk is an investment risk. We're on the end of a fundamental reshaping of finance, he said, referring to environmental and sustainable investments. It is generally accepted now that whether investors focus on financial returns or on long-term sustainable revenues, they need to take into consideration environmental, social, and governance. That's the ESG that Zakari mentioned in the beginning, criteria. They will allow them to identify risks and they will present new investment opportunities. Transparency is becoming an important consideration too. Today, private investors have the opportunity to decide what they consider to be in their best interest, how they should best invest their capital, and the accountability they should expect from their investment partners and companies. Many individual investors have already moved to the next level, in which their investment strategies give emphasis to ways of how to best build a sustainable criteria, how to build in sustainability criteria to support their goals. Maybe I'll put my screen back for you to see the final slide, because this refers potentially the most important thing I wanted to say actually, but as you would expect, technology breaks down when you reach the end. That's what I want to show you. Excuse me a minute. Okay. So we have environmentally related sustainable investment opportunities, governments focusing on sustainability and giving incentives, and companies pay more attention to sustainability and stakeholder interests. I read you the quotation from Larry Fink. And finally, the transparency, which is becoming an important consideration. Investors expect transparency of how the companies they're investing, what they're doing with their money. Let me then conclude. The disruption triggered by COVID-19 pandemic has highlighted the need for environmental, social, and governance investing, ESG, be it institutional or privately managed. The sudden stop in the global economic activity led to a reduction in carbon emissions, bringing home the fact that a change in human behavior can have quick positive consequences for the environment. The crisis has amplified the need of mitigating investment risks that arise from natural calamities. These are the same risks that might be present in longer-term trends, like the buildup in global CO2 emissions and the resulting natural disasters caused by climate change. And I leave you with the thought of Larry Fink, as he put it: climate risk is investment risk. And that's something we should always bear in mind. Thank you very much for listening to me. I pass on back to Zachary.
Climate risk is an investment risk. So a great way to end the presentation. I have so many questions for you, Sir Christopher, but we'll get to those in the Q&A session. It's now my pleasure to introduce Andreas Matsas. Andreas has vast experience in investment banking, including at HSB Investment Bank in London. He has been advising corporate clients and institutional investors on investment portfolios and diversification. He's a director in various companies in financial services, regulated by the SciSec Commission, as well as of an electronic money institution regulated by the CBC. Andreas holds a bachelor degree in economics and quantitative techniques and an MBA from Imperial College in London. He's a member of the CIM and the Institute of Management in the UK, and is a fully credited management and financial consultant by the ICMCI, and is a licensed stockbroker by the Stock Exchange Commission in Cyprus. Andreas, now that Sir Christopher has painted the backdrop, please tell us how alternative investments paint the way forward in this economic environment.
Thank you very much, Zachary. Well, taking the floor from a Nobel laureate, I'll try to be concise and factual. But first, let me share my screen so that everybody can follow through. Right, we'll be talking about alternative investments, the way forward. Let's start by the global investment landscape seen through investors' eyes. Well, Sir Christopher has already indicated that we are witnessing a dramatic shift from traditional investments to a new asset class, which in effect relates to direct investments in the heart of the sustainable economic activity. Bonds are gone. Capital markets, we have all seen, have become volatile and very uncertain. So is alternative investments a new proposition to investors? Given the current state of uncertainty, investors are seeking sustainable returns and safety of capital. Now, these investors are likely to turn to alternative investments. We have seen bonds generating low or even negative yields. We have seen a tremendous volatility and uncertainty in the capital markets. So this is, we feel, the new proposition to investors: alternative investments, investing in a sustainable economy. But what kind of alternative investments should we aim for? Well, just a month ago, from the stage of the annual Helexpo Forum in Greece, the Greek Prime Minister announced the government's decision to promote and incentivize private, green, and digital investment initiatives. He went on to substantiate this announcement by emphasizing that Greece will be receiving 32 billion euro from the EU Recovery Fund towards promoting and supporting such private initiatives. On the other hand, the European Commission is currently preparing a comprehensive offshore renewable energy strategy in its pursuit to become the first climate neutral continent by the year 2050. You understand, a plethora of incentives will be offered to such private institutional investors who will decide to engage in such long-term sustainable investments. And we at Corinth are planning to be one of them. As Sir Christopher pointed out, ESG, environmental, social, and governance criteria, are now becoming the norm. They're becoming an integral part of investment strategies of the future. Such criteria will mitigate risks in investment strategies from natural calamities, such as COVID-19. We at Corinth will be focusing on alternative investment strategies with long-term and sustainable revenues in the following sectors: renewable energy, waste management, recycling, and sustainable food industries. Our mission will become synonymous to sustainable growth, superior returns, and serving the society at large. But let's see now, how could investors actually best engage in such sustainable investments? Collective investment schemes. Let's have a look at alternative investment funds. A collective investment schemes means for investors to join forces and invest through such an institution. Let me just highlight the advantages of an alternative investment fund by giving you an account of what we do, of how we do things at Corinth. First of all, there is the ability to engage in asset diversification within a single portfolio, thus managing our risk exposure. Secondly, we have access through a global network to a plethora of investment opportunities. Then we have the right evaluation mechanisms, the vetting process for projects, for evaluating the projects before coming to the investment committee for funding, understanding the potential, business and sector potential, carrying out due diligence, research and analysis on micro and macro level, financing and tax optimization, cash flow and margin improvements. Once we decide to invest in a specific project, then we have the ongoing steering and oversight of our portfolio companies. And another thing that we do at Corinth, we have control of the projects that we invest in through the pledging of shares, through control over voting rights, and through securitization of assets. And last but not least, we are innovating through the introduction of a project insurance cover, which effectively safeguards our investors' capital. Another advantage of collective investment schemes is corporate governance through the designated bodies, such as the investment committee and the advisory board. The presence of many control functions enhancing credibility, bargaining power through joining forces and commanding higher volumes. Also, useful structures accommodating specific investor needs. For example, at Corinth, we have chosen to set up a registered alternative investment fund, which is effectively an umbrella fund with multiple investment compartments, allowing us thus to implement various strategies, invest in different asset classes and in different geographies. Moreover, this structure allows for cross-border activity. And at this point, I think it's important to announce the establishment of a feeder fund in the United Arab Emirates in Dubai in order to accommodate demand from our from interested investors there. So we have seen some advantages of the collective investment schemes. However, collective investment schemes without regulation are not good enough. So let's just look at regulation for a minute. Regulation through the supervision from competent authorities, in our case, the Cyprus Securities and Exchange Commission, and also ESMA, the European Securities and Markets Authority, which is the European regulator under which all the national authorities operate. So the regulation through these competent authorities secures the transparency through reporting and disclosure obligations, both to the regulators, but also to our investors. Through the implementation of best practice policies and principles, regulation also ensures that operations are carried out in a compliant manner with all risk management practices in place, and moreover that the people who actually carry out these operations are fit and proper. Finally, let me touch upon jurisdiction considerations. We have chosen Cyprus. Why? Well, Cyprus is becoming a location of choice for international fund managers and investors. It's interesting to note that Cyprus funds at the moment are eligible for listing on important global platforms like Bloomberg, Clearstream, and Thomson Reuters, thus becoming visible and accessible to all fund managers and investors all over the world. The fact that through our setup in Cyprus, we can passport our fund's license within the European Union and even cross-border our license in non-European Union countries of choice. I've already mentioned the example of UAE and our feeder fund in Dubai. Moreover, the national framework in Cyprus is fully aligned with the European Union regulatory framework, offering transparency, quality, and efficiency. For example, there is minority protection. There are provisions for conflicts of interest. Another advantage is obviously cost effectiveness compared to other European Union fund jurisdictions, which allows higher returns to our investors. Favorable tax regime is also important. We have no withholding tax on dividends and no capital gains tax upon the disposal of investments. And finally, as we all know, the strategic location of Cyprus at the crossroad of three continents gives us easy access to high growth markets. Well, that is all for me. Thank you very much for your attention, and back to Zachary.
Thank you, Andreas. We have so many questions coming in through the Q&A. I wanted to start with a question for Sir Christopher. How fast can we expect the economic recovery to actually be realized? There's discussion about K-shaped recovery, W-shaped recovery. And how can those expectations actually affect our investment decisions in terms of geographies, in terms of economic sectors, picking winners and losers from this economic environment?
All right, thank you very much. A very good question. At the beginning of the pandemic, I was also trying to figure out, is it going to be W-shaped, V-shaped, and all that. Now I think that's irrelevant. And the reason is that we're now entering a new normal situation, one in which companies do things differently. And the companies that learn how to do things differently, that learn how to collaborate with their employees working from home, the ones that have good health standards at work, the ones that are taking on the automation faster, will recover even if we don't have the vaccine yet. The reason for those W-shaped and V-shaped is how long will the pandemic last? Obviously, it's a big consideration, don't get me wrong, because there are huge sectors of the economy, like the entertainment sector, the hospitality sector, travel, that do need a recovery, do need a cure for the disease, for COVID-19, if they're going to be recovering fast. But there's a lot of other businesses that don't really need it. They might benefit from it, but don't need it. So how fast we can expect to recover will depend very much on whether countries are doing the right things to encourage their companies to do that, whether their companies following the right policy. It's not a kind of general statement that we can make that applies to the global economy and to everyone else in that economy. Now, you mentioned geographies. As I mentioned during my talk, the high-income countries of Europe and North America and Japan, South Korea, in fact, and China, are better placed to recover fast than others because they have more flexible markets, they have more automation, more robotics, they are doing more research, and also they have an occupational structure that can be delegated out away from the office. In terms of sectors, sustainable energy, technology, environmental will attract a lot of attention, a lot of support from governments. Manufacturing should be recovering fast because it doesn't involve many people, it's not labor intensive. But as I mentioned, look at travel and hospitality, and that I don't see that recovering fast without the vaccine. That's it.
So a question from one of our audience members, Philip Spanos. We were discussing this session as the global investment landscape heading for a reset, and Mr. Spanos has referred to this as in another light as a tipping point. So his question is for both of you. So we'll maybe start with Sir Christopher and then hand over to Andreas. In the view of what's been said, are we at an ESG, a sustainable, ethical ESG tipping point? Specifically, what is the view regarding the Chancellor's proposed carbon tax? Will this succeed in light of many previously suggested related approaches?
I think I see a kind of maturity, if you like, in the way people think. When it's an entirely new idea and you're going to switch existing norms and practices, it's not easy to do it. There are a lot of vested interests. There's going to be a lot of resistance. But it's something that was an underlying trend. It has been an underlying trend for a long time. More and more people and governments and companies were going around to the view that these concerns are going to be important. With more sort of natural disasters happening, flooding, ice perhaps melting, and all that, we're becoming more and more aware. And then suddenly something like COVID hits you and gives you a kick up the backside, if you like, and it tells you, we're here. It's not something that you can afford to wait to do. So I think it is a tipping point this time, actually. I mean, the United States and China are very, very big players. We've already seen a change in Chinese attitudes. Now they're talking about the 2050, 2060 to be carbon free, which I believe is the first time that they're being so specific. We're not seeing anything from the United States yet, but hopefully last 4 years were an aberration that will not be repeated, be it Republican or Democrat in the White House. I don't think the Trump administration took it very seriously or took the advice of scientists very seriously in the United States itself.
Andreas, if we could ask you the same question.
Well, as Sir Christopher pointed out, the COVID pandemic was basically a wake-up call for everyone, and has actually urged governments and institutional investors to speed up what they have already been doing, that is moving towards sustainable investments, because at the end of the day, sustainable investments produce superior returns. It's a good thing for the society, for the planet, and at the same time fit all these environmental, social, and governance criteria. We have seen governments already offering generous incentives, not only tax incentives, but even grants and many other ways of motivating institutional investors to engage in such projects. We feel that the early entrants in this arena of sustainable investment will be the big winners. And that's our core philosophy here at Corinth.
So another question from the audience regarding this no yield, low yield environment that we find ourselves in, presenting the case for alternative investments taking a more important role in the portfolio. This is a question from Hrafn Arneson. Apologize for mispronouncing your name. How should a strategic investor consider their alternative investments as part of their portfolio? Looking at private equity, private credit versus traditional listed instruments like stocks and bonds. Maybe starting with Sir Christopher and then Andreas again.
I think Andreas is better placed to start on this one, actually.
Okay.
Portfolio arrangements.
Sure.
Our theorist over here.
Thank you both. Actually, the fact that we have designed our business model around direct investments, private equity investments in the heart of economic activity, as I mentioned during my talk, is because first of all, we can maximize our returns because we're not entering such investments through brokers or platforms, but we actually partner with such entrepreneurs, such project owners who have good projects. And since our evaluation processes, our due diligence, our micro and macro analysis prove that such projects have great potential, and in the cases of sustainable investments, we often have even the offtake agreements in place, then obviously this is a way to maximize returns and at the same time create a long-term sustainable stream of revenues. We can take a specific example, if you like, of let's say a biogas project or a tire pyrolysis project. Actually, a tire pyrolysis project is in our pipeline, and we're actually we're in the process of vetting such a project. We have the raw material in place, the used tires, we have the technology, and we have the offtake agreements from the big tire companies, which will be buying the output. If all of this is in place, if our due diligence proves that we have all the license, permits, and everything in place, then this is a winner. This is a project generating superior returns. It's a long-term project which will be offering our investors a future solid stream of revenues.
So Christopher, going on this, some of the opportunities that this has created, how can governments intervene in order to aim to incentivize sustainable investments? And do you think they actually will?
Well, governments can do it in a number of ways. The obvious ones are tax incentives in the form of deductible spending on these investments from taxes, some more facilities, but more interesting in a way, sort of more exciting opportunities, if you like, is that I see governments encouraging it through public investment in infrastructure projects. For example, if you're talking about energy, let them put in place the infrastructure for the transmission of energy, storing, which is very difficult. For example, if you have a country which is sparsely populated in some parts and there are parts that attract a lot of wind, then government will need to put the infrastructure of carrying electricity from one to the other, or even neighboring countries. In fact, I'm involved with electricity connections between Egypt, Cyprus, Greece, Israel, where at different times of the year you use renewable energy in different countries to transfer electricity between these four countries. That contribution of governments, I think, which I see taking place now as we speak, is going to be more important in encouraging investments in ECG than the tax incentives, which also, of course, play their role. Then, of course, we shouldn't think that of governments doing things in the best possible way. Always, sometimes we get stuck into administrative nightmares and delays and all that. Then again, governments can help if they develop a flexible system of licensing, of checking if the investment is good or if it's going to benefit rather than harm, having a good legal system for the resolution of disputes very quickly. That's another aspect of government contribution with these investments. And that's where I see governments going. In fact, I think there's one question of what are we going to recommend to the Greek government for encouraging such investments, and spot on is what I just said. Simplify your procedures, do your reform in the public sector and the judicial system, put in place the infrastructure, digital and non-digital, and then private investments into these sectors of the economy will immediately flow.
Thank you. And having highlighted the impact and potential impact that governments can have on investments, on the investment landscape, it's hard to ignore the potential of a outcome of the U.S. election. The U.S. election, this election is probably likely to have a greater impact on global financial markets than any election in recent history, I would argue. A question starting with Andreas and Sir Christopher as well. What impact will the U.S. election have on your investment strategy, and what do you think are some key considerations for that investors should take into mind depending on the outcome of the election in the U.S.? This is a question from Michael Givens.
Thank you, Zachary. Well, as I said in my previous intervention, what we do at Corinth is looking at each project on its own merits, in the sense that what we call our vetting process, the evaluation procedure, in other words, which includes due diligence and all the checks that we need to do, will also include, once we know the outcome of the US elections, will also include analysis on the macro level and how this project or its potential, or even the place in which the project is located, because let's not forget, we will be investing where we find good projects, which means globally. We have no restrictions whatsoever in the geographies that we will be investing in. However, the outcome of a US election, we all know, and I'm sure Sir Christopher has more expertise in explaining to us what we should be expecting. But as far as the investment strategy is concerned, depending on the nature, on the industry and the geography that we will be investing in, we will be considering how the new reality in the US and the new US approach to the rest of the world might affect such an investment in such an industry, in such a geography.
Yeah, I mean, if I could add, there is, I think probably for the first time in thinking back, I'm being kept awake at night by an election taking place in a foreign country from the one I live. I'm terribly worried, actually, to tell you too, about the outcome of the election, and not only for the economic implications, also for political. I mean, I don't mean necessarily the policies that the different parties follow. You know, those I can sort of evaluate and tell you which one I prefer. But also about the personalities involved, especially one personality involved that we had so many bad experiences from the current administration, with the president throwing tweets which go against all scientific research, advice, you know, I mean, like swallow antiseptic to kill the virus, you know, that kind of thing that has come. That I am worried in terms of where is the West going if the leader for the next 4 years is going to be what we have so far. And I'm saying it's not because I want to sort of campaign for the Democrats or Republicans. I mean, it's particular personality involved. But if I can be more specific on the economic implications, it does worry me an awful lot that there is so much being said by the current administration against or diminishing things like ESG investments, healthcare, the importance of the pandemic. You know, we saw Fauci, the chief scientist in the United States, complaining today. It was reported that he was saying that this is false. It's a false claims that were attributed to him. We see, I mean, if I'm going to believe my American colleagues, and I have no reason not to, we see the oil and coal lobby being extremely influential in the policies of the current administration. You know, the Coen brothers, for example, giving millions and millions to the party power, and then policies being directed to their interests as environmental, withdrawing from the Paris agreements. All those things are obviously not good. My only so what puts me a little bit at ease, as I say, when I wake up in the middle of the night. I used to wake up at night because of an election during the Brexit referendum in Britain, but I've lost there, and now I can sleep in peace. I know where we are. But I mean, the hope that I keep thinking, you know, there is some hope, is that the European Union is taking a stronger and more independent attitude. You know, we can go, we have to go our own way on ESGs and the environment, and it is a big economy. You know, it's 500 million people. If you add it all together, I think it's probably bigger than both the United States and China. It's just that it's not counted as one single economy. That the Chinese are saying they're the second biggest. They should be saying that the third biggest if you count the European Union as one. I'm not sure actually if Britain leaving has tipped the balance to just below there, about the same level, US and European Union. And Europe is determined to go that way. The Green Deal is tremendous. All governments are committed to it. I know that the Greek government is very committed to it. They're switching, they're seeing what incentives to do to speed it up. And hopefully we'll be having more independent policies in the right direction in Europe, whatever the outcome of the US election. But there's no doubt that the change of administration will help enormously the economic landscape. And even more the political landscape, actually, I should say, but anyway.
So, as a key economic advisor to the Greek government, and in your position as chair of the Economic Committee of Greek Economic Growth, for advising the Prime Minister of Greece, you're no stranger to dealing with countries that are trying to achieve growth following a prolonged recession. What are some of the key growth drivers? What are some of the key things that government should focus on? And one of the other questions from Konstantinos Neophytou, again, apologies for mispronouncing your name. What are the key priorities of Greece and Cyprus for the EU Recovery Fund?
Well, I mean, Greece, as you said, has been in a long recession because of its debt problems. And in fact, even going further back, Greece was never, even when it was growing, it was not really growing because of fundamental productivity rises in the economy. It was more like residential booms, that kind of thing. And the Prime Minister of, the current Prime Minister of Greece, in fact, talked to me even before the election, before we knew about COVID, that he was really determined to carry out reforms and modernize the economy, bring it up to the level of the smaller Northern European countries, if you like. And would I be interested in helping with the reform program? And I said, yes. Now, soon after his election, though, less than a year after, a pandemic comes along, and the European Union comes and offers a lot of money for recovery, New Start projects and all that. And our work has suddenly become more important. Suddenly the Greek media discovered us and there are references to our work on a daily basis. And what we are doing is more or less a transcription, if you like, of what I said earlier about recovery and the new realities to the Greek situation. Greece used to have, there have been a lot of improvements since, but it used to have a very rigid administrative structure, the public sector, the judicial system. Reforms have already taken place, and we're recommending even more along that direction. We're recommending a new digital infrastructure, which has started. You may have seen, especially Mr. Neophytou, which you pronounce very correctly, by the way, the name Neophytou, that only last week, Microsoft announced a huge investment in Greece to put the cloud. As the Prime Minister said, Greece has been famous for its sunshine, now it's becoming famous for its clouds too. All those things are in the right direction. And once that's done, then the framework for productive and profitable investments will open up in Greece. If you look at it now and you say, tell me the number one big problem in Greece, what would I say to you? I'll say to you, very low productivity because of very low investment. Investment in Greece currently is about 10 to 12% of GDP, which is just enough to maintain the capital stock. Nothing new really is taking place on any sizable scale. And as a result, productivity is extremely low. But once these things are done, which the government has started already, partly based on what we said in our preliminary reports, and now this week we are due to submit our final report. it will open up the scope for more investment. It should jump up from the 10 to 12% to something closer to 20% in the next 5 years. Obviously a gradual process, but it's coming fast in relative terms. That will increase productivity, and it will give a lot more emphasis in these new sectors of the economy, as we're already seeing. So I'm very optimistic. The government has a good majority, it's a good stable government, it has a lot of support, and they are determined, you know, especially the Prime Minister himself. He's a young man educated at Harvard. Back in Greece, he's seen how well-organized economies are run, and that's what he wants for Greece. So he has my full support.
Thank you. Another question actually from Mr. Arnason, and I'll start this with Andreas, please. In light of the discussion, governments all over the world are seeing more borrowing and increasing their indebtedness, monetizing debt, doing this to weather the COVID storm, and pray that consumer spending and private investment will eventually catch up and generate revenues for governments to be able to service the additional debt. Question initially for Andreas: what are the repercussions that can be expected in the global investment arena?
Well, this is a question to the point. And once again, I will start by saying that during an evaluation process, especially at the macro level, the macroeconomic situation in a country that we will be investing, and also the specific sector that we will be investing in, will be a big part of the equation and our decision on how to move forward. However, as we have already mentioned, especially Sir Christopher has touched upon it, we are seeing very important stimuli from governments, even though we are still going through a period of high national debts. And if I can go back to the example of Greece or even Cyprus, where I am, the percentage of the national debt to the GDP of the country is very high. However, the government's strategies, along with the funds that will be offered through the European Union Recovery Fund, actually have two main focuses. One is to reduce debt, and the other one is through private initiative, private investments, which the governments will be supporting and incentivizing to create a cyclical economy, to invest in these sustainable projects, which will in turn give increase productivity, reduce unemployment, and thus create the required cyclicality in the economy, which will eventually bring the debt down. It's tricky times. I mean, we live in tricky times, but we feel that this is the right moment because of this specific timing and the wake-up call from COVID. It's the time to focus, to concentrate on such investments on the way to recovery, both at micro and macro level, which includes obviously national debts of various governments, various countries.
So for Sir Christopher, the second part of this, Mr. Arnason's question is whether governments all across the world can continue to access debt markets simultaneously. And if you allow me, I'll put on my MMT hat for a moment, because MMT seems to have come from the fray to now being central to a lot of economic thought and policy that seems to be coming forward. What are some of the key differences between certain countries that have the benefit of being issuers of currencies and those that are just currency users?
Well, first let me tell you, it's not an area of economics that I specialize. I'm speaking more as a generally educated economist rather than that. I mean, with the exception of countries like the United States and possibly China, actually, that are very big and issue currencies that people are prepared to hold, I don't really see much difference. All we talk about issuing new digital currencies, doing it through the IMF and all that. I don't really see it. I see from my university when monetary economists are talking about it, it's very difficult to break the current institutional structure that we have in institutional architecture, I should say, that we currently have, and I don't really see. I mean, there are tiny fractions of their GDP where they would make a difference in real terms. So overall, I don't think it's not an area that worries me very much. Let me put it that way. I don't think you should worry investors whether they're issuing currencies or whether they have reserve currencies or not and use other countries. It's not very interesting. I'm sorry about that. It might be my final contribution as well. It's not very good, but that's the way I look at it.
Well, I'd love to ask more on that subject, but we do find ourselves completely out of time and actually over time. We haven't been able to address so many questions in the Q&A. Again, thank you to everyone in the audience for the engagement. We have 30 questions that came in the Q&A. We had a whole bunch of questions that were submitted in advance of the session as well. We addressed as many as we could. But a question for both of you, just a very short one, if I may, from James Dirty, which I think would be a very interesting question to end the session on, is what do you see as the #1 greatest challenge and risk to the current recovery? Maybe starting with Andreas.
Well, the COVID-19 pandemic caught us all by surprise, but it was also a wake-up call. So let's just hope that the message was so loud and so clear that governments, large institutions, powerful lobbies, etc., will be better prepared in the sense that there will be the necessary investment will be made in infrastructures like the health infrastructure, in order to prevent something similar. Obviously, there always can be a force majeure in any strategic initiative. But I feel that a careful assessment before actually engaging into an investment can foresee such eventualities. And here, maybe it's also a good time to repeat once again that because we have seen, I mean, we have realized at Corinth that such unforeseen events might occur again. That's why we are building our insurance cover around every single project that we will be investing in order to safeguard our investors' capital.
Okay, now in terms of risks, I'm not too worried. I mean, the personal worry, of course, by COVID and its progress, because I do trust scientists that they're going to find a vaccine sooner or later. So in a worst case scenario on the health side is that COVID will be another, worst case scenario is that it would last forever and it will be another type of flu. You know, the flu vaccine exists, we take it. It's about 70% effective. People die if they have the older ages, history, and all that, but we don't sit there worrying about flu all the time. And COVID might become like that. That's the worst case scenario. The best case scenario is that the disease is eradicated and we forget about it the way we've forgotten about the Spanish flu of 100 years ago. That's not to worry. I think, quite honestly, I'm completely an apolitical person, believe it or not. Given what I said about Greece and other countries, and whereas I'm completely focused on the economy 100% of the time, but the biggest risk coming out actually is the United States. Is what's going to happen to the United States. I mean, the United States has been a leader of the Western world for the last 70 years at least. We look at it, in Europe, South America, elsewhere, sort of for guidance is where is the biggest economy, biggest trader. And if we're going to have another 4 years of uncertainties about climate change, no, it's not true, don't believe them. We're going to recover very quickly, and we go back to our old ways of doing things, of pre-pandemic, where the rest of the world is moving in a different direction. Europe in particular, and Japan and everyone else, in the Middle East, of course. And then at the same time, we have all these political disturbances of going on in the Middle East, for example, which are due to a very large extent to the complete lack of interest of the Trump administration in the withdrawal from the area 2 or 3 years ago. That does worry me about where we're going. It's partly connected to COVID, because I'm saying that we shouldn't go back to the old ways, pre-COVID ways, when we come out of the pandemic. And it looks like in the United States, they're prepared to go back to their old ways if we have the same administration post-November 3. It's also so the general picture, where are we going in this world? And we do need our biggest economies and most influential countries to behave in a predictable way.
Absolutely. And thank you again so much I couldn't agree with you more. Again, we do need to really use this painful lesson that we learned to prevent us from the more painful risks that we face. Should we continue to ignore scientists? Should we continue to ignore the issues that we are being warned about for global health, for the global climate? And that, again, comes back to one of the key and central points to our discussion, the importance of ESG. Again, thank you so much for participating in the session. Sir Christopher, Andreas, this has been very informative. I have so many compliments from the audience. For the audience members, thank you so much for engaging. I'm sorry that I wasn't able to address more of your questions, but your questions will be shared with the speakers, and they will certainly do their best to follow up with as many of them as possible. The slides from the session will be distributed to the audience. This has been a great session on the global investment landscape heading for a reset. We covered so many topics. We covered the expectations of the economic recovery, how that should affect our investment decisions, how the pandemic has reformed our approach towards sustainability. We've looked at the role of alternatives and the increasingly important role of alternatives in our portfolio in what will be a low interest rate, high expensive valuation equity, public market equity valuation market. We touched upon Greece, we touched upon the European Union, we touched upon politics, the US elections. It was so much to cover in such a short amount of time. I hope that everyone found this session to be informative. Following on so many questions and so many issues around this US election, the importance that it has on our portfolios, on our investment decisions between now and the end of the year and for times to come, and the potential major divergences in policy depending on those election results. We will actually be hosting a dedicated session next week on the 15th of October, Thursday at 4 p.m. Gulf Standard Time, all about the election. Sorry, that's this Thursday, the 15th, this coming Thursday, the 15th at 4 p.m., talking about the K-shaped recovery, expected inflation, and focusing on the importance of the U.S. election around that. This session will be sponsored by Saxo Bank, and we'll be joined by Saxo Bank's Chief Investment Officer, Steen Jacobson, as well as John Hardy, their head of FX strategy, as to how you may be able to take advantage of this election and potentially trade the election in your portfolio, giving you a bit of a playbook. Again, remember, if you are joining us on YouTube, please like this video, subscribe to our YouTube channel. Please make sure that the AIM Summit team has your details so you can be invited to the live sessions and actually ask your questions, and we can address them during the live webinars as they happen. Again, thank you both so much, Sir Christopher and Andreas, and of course, a major thank you to the sponsor, the Corinth Group of Companies, for making this session possible.